Today, we're digging into the financials of AAR Corp, a key provider of aviation support, parts, and maintenance.
Right, and the core question for AAR, I think, is pretty stark. You've got this really compelling operational growth, real strategic dominance in the commercial aftermarket. Does that strength fundamentally outweigh the persistent risks we've seen materialize? These recurring integrity issues, compliance failures. It's really about momentum versus governance.
Exactly. And my position is straightforward. The core business is strong, the growth metrics are undeniable, and the strategic moves they're making, they justify a premium valuation in my view. I see these compliance problems as essentially manageable costs. They're significant, yes, but they're largely dealt with. They're in the past.
Okay, I'm going to come at it from a slightly different angle. While I absolutely see the enthusiasm for the operational story, I think the pattern here, the documented legal liabilities, the ethical questions, introduces a really substantial governance risk. And I'd argue it's not temporary, it feels more structural. That, for me, demands a pretty deep discount on any intrinsic value calculation. We can't just, wave away the long-term cost of this kind of corporate behavior.
Okay, let's start with the operations and the financial outlook, because honestly, AIR is hitting its targets. Q1 fiscal year 2026 showed really robust 17% organic sales growth, and that's overwhelmingly driven by the commercial sector. Now 71% of their total sales. That's focused momentum right there.
Mm-hmm.
But here's what I find really compelling. The forward look embedded in the stock price. Now, the trailing PE, yes, it's high, 106.25. That reflects some past volatility, maybe some investment spend, but look ahead. The forward PE plummets to 16.06.
That is a dramatic shift.
It is. And that massive change isn't just a guess, it's a powerful statement of market confidence. It implies analysts expect a huge leap in next year's earnings per share. The projection is around $5.24. And look, this isn't just based on hope. The growth is underpinned by concrete strategic moves, like expanding their MRO maintenance, repair, and overhaul capacity in Oklahoma City and Miami. And critically, these expansions, they're already fully contracted. That adds 15% capacity by calendar year 2026 and essentially locks in future revenue. Plus, management seems serious about financial discipline. They're aiming for a lower net debt leverage, targeting 2.0 to 2.5 times, which potentially opens the door for share repurchases down the line.
Those numbers are certainly attention-grabbing. But let me offer a different lens, focusing maybe less on the rate of growth and more on the quality of it and stability of it. That dramatic forward PE drop you mentioned, it's definitely eye-catching, but it really hinges on perfect execution, doesn't it? And critically, no more major legal surprises cropping up.
Well, execution risk is always there, but...
Right. But look at the intrinsic value models for AAR. The market's got it around, $84.84 currently? Yet the expert valuations are all over the place. They swing wildly from a very bullish $131.19 down to a quite bearish $60. And this is as of October 2025. That huge gap, basically a 2x difference between the high and low estimates, that's a major warning sign to me. It signals fundamental disagreement on how reliable those future cash flows actually are.
Mm-hmm.
And the operational success you're highlighting, it keeps getting overshadowed by these really severe integrity risks that have cost them dearly. We have to remember, the company paid over $55 million, $55 million just in December 2024 to settle those FCPA, Foreign Corrupt Practices Act, bribery allegations. This was tied to contracts in Nepal and South Africa. That's not insignificant. It's a massive, self-inflicted financial hit. And that came after an earlier $11 million settlement in July 2021 for a False Claims Act case related to improper maintenance on government contracts. These aren't small bumps. They are substantial, seemingly recurring financial and reputational hits. And that, for me, absolutely justifies applying a conservative discount, maybe pushing the value closer to that $60 estimate.
Okay, let's pivot to our first core contention then. The sustainability of this commercial growth versus some of those operational constraints you've touched on. I still maintain the growth engine, especially in parts supply, which saw, 27% organic growth in Q1, is structurally sound. And it's sound because of strategic differentiation.
How so?
Well, it comes from securing exclusive distribution deals with original equipment manufacturers, the OEMs, and smartly leveraging their digital tools like the Trax software. That big contract win with Delta TechOps, that's proof of their digital edge. They're also cleaning up their portfolio, selling off the non-core landing gear overhaul business, lets them focus resources squarely on those higher margin activities. It feels like disciplined execution aimed at really dominating the aftermarket, not just riding a general market wave.
That's a fair point on strategic focus, but have you really factored in the bottlenecks? The ones that are external but still fundamentally cap the margin potential. You talk about MRO expansion, which sounds great, but capacity is meaningless without people to do the work. We know the whole industry faces this persistent MRO workforce shortage, that mid-skills gap. So even if the capacity is contracted, if you can't staff those new hangars efficiently, you can't actually maximize the revenue from those contracts.
But isn't that an industry-wide issue?
It is, but it's a constraint nonetheless, and it's not the only one. Even their profitable USM segment, used serviceable materials, faces headwinds, at least in the near to midterm. USM depends on older planes being retired and parted out, right? But airlines are currently extending fleet lifespans because new planes are delayed or expensive. So the supply of those used parts that AAR needs is tightening, putting pressure on their costs and margins. So yes, the demand is resilient, but these structural constraints absolutely limit how much those margins can really expand, which tends to validate the market's more cautious valuation multiples, like that EV/EBITDA around 1650.
I have to push back slightly there. You frame these structural risks, the skills gap, USM supply, as if they uniquely cripple AAR. They are, as you said, industry-wide headwinds. The fact that AAR can sell 15% more capacity 2 years out, knowing these constraints exist, suggests to me they might actually be navigating these risks better than their competitors. The market likely has already priced in some difficulty in sourcing labor and parts. But this brings us right back to the core tension. The operational story looks strong, but your main critique is centered on integrity. So let's really tackle the cost of that $55 million FCPA settlement.
Absolutely. It's central, because that $55 million fine, it's not just a one-off cost you write off. It points to something systemic, something potentially ingrained in the corporate culture. The investigation found these bribery schemes ran for 5 years, 2015 to 2020, across different regions. That kind of duration suggests a fundamental breakdown in internal controls, in oversight, likely reaching pretty high up. And this pattern, this sort of aggressive behavior, it seems reinforced by their domestic strategy too. Remember, AAR quadrupled its lobbying spending during the Trump administration. That coincided with them landing about $1.35 billion in new federal contracts by October 2020. So you have this picture of reliance on intense political influence at home and, allegedly, corruption overseas. For me, that introduces a deep discount factor that you have to apply to future cash flow projections because it signals significant underlying governance risk.
I think that interpretation might be a bit too narrow, though. Crucially, the company resolved these FCPA issues through a non-prosecution agreement. That's important because it mitigated the immediate existential threats, things like criminal charges or, worse, long-term debarment from government contracts. So the legal costs, while substantial, are now effectively sunk costs. The focus immediately shifts back to the operating fundamentals, which, as we've discussed, are looking pretty good.
But the pattern.
And importantly, they continue to win major stable defense contracts. Look at the exclusive distribution deal with AmSafe Bridport or the critical DLA troop support contract. The defense side provides a vital counter-cyclical revenue stream. It helps balance out the commercial volatility and the international risks you're rightly concerned about. So I believe the market is probably correctly prioritizing the current strong revenue stream, estimated around $2.5 billion for 2024, over these historical liabilities that have ultimately been settled and accounted for. All right, let's move to our final contention: how we interpret management's capital allocation strategy. From my perspective, management is channeling capital quite smartly towards strategic acquisitions. Think about Aerostrat, which enhances the IP within their Trax software, or ADI American Distributors, which expands their parts distribution footprint. Aerostrat, for instance, focuses on MRO forecasting and planning software that directly bolsters the high-margin, kind of sticky digital capabilities of Trax. This feels like a forward-looking approach, and it supports those higher intrinsic value estimates we saw the 102 up to 131 range, because it strengthens their market share and digital presence, helping to solidify their position against competitors.
Yes, those acquisitions look strategic on the surface, but management's first stated priority right now is actually debt reduction, getting down to that target leverage range of 2.0 to 2.5 times. To me, that signals management's primary focus is actually caution, its balance sheet repair, maybe not the aggressive, high-confidence expansion that would justify those really top-end valuation estimates.
It's prudent financial management, though.
It is, but it's cautious. And furthermore, we probably shouldn't ignore the insider trading data. We've seen pretty consistent sales by multiple top executives, the CEO John Holmes, CFO Sean Gillen, selling shares throughout 2025. Now, when the people who know the company best are consistently taking money off the table at current prices, well, it suggests they might see this as fair value now rather than holding out for those much loftier implied values over $100. It just serves as a bit of a counterweight to the pure operational optimism.